Welcome to Iron Financial. This is the place where we help you forge a stronger, more resilient portfolio. Today, we're putting Lidar giant Hesai under the microscope. And let me tell you, we just witnessed a seismic event in this industry. For the first time ever, a Lidar company has actually forged a full year of GAAP profitability. This should have been a champagne-popping, market-roaring moment, but it wasn't. Not even close. Exactly. That's the real question, isn't it? It's the paradox at the heart of this entire story. You've got these incredible headline numbers, we're talking record revenue, shipments going through the roof, and, for the first time in the history of this sector, actual black ink on the bottom line. So why on earth did the market see all that good news and immediately slam the sell button? Are we looking at a momentary, irrational panic? Or is there a deeper, more fundamental crack in this company's foundation that the sharp eyes on Wall Street spotted before anyone else? That's what we're here to figure out. All right, let's get to work. Here's our game plan. First, we're going to dive headfirst into that profitability paradox by forging the bull case piece by piece. Then, we're going to put on our skeptic's hat and start actively searching for the cracks that sent the market running scared. After we've examined the weak points, we'll look at how the company plans on reinforcing its future. And finally, you'll get the official Iron Financial verdict. Is Hesai truly built to last, or is this just a shiny facade? Okay, let's start by building the bull case. And we're not going to build this on hype or narrative. We are building this from the ground up on a foundation of pure, solid steel. The hard, undeniable numbers from their 2025 annual report. For a minute, I want you to forget everything you've heard, forget the stock price, and just look at the data. Because the numbers themselves tell an incredibly powerful story of operational mastery and absolute market dominance. First step, let's talk about the sheer velocity of their growth. We're looking at a 45.8% year-over-year revenue explosion. Think about that for a second. That surge rocketed them to over $430 million for the year. Now, in a capital-intensive industry like this, an industry that just eats cash, that kind of top-line momentum is the engine that drives absolutely everything else. It proves that the demand people have been speculating about for years isn't just some concept on a PowerPoint slide. No, it's real, it's here, and it's translating into massive, massive sales. And this right here is the crown jewel. This is the critical milestone. Just look at the power of this swing. In 2024, they were in the red, posting a net loss. You fast forward just 1 year, and they've swung with incredible force to a massive net income. Let me be absolutely crystal clear about this. Hesai is the first Lidar company on the planet to achieve a full year of GAAP profitability. And when we say GAAP, we mean by the book, no funky accounting, no adjustments, just pure, unadulterated profit. This isn't just a win for Hesai. This is a landmark moment for the entire Lidar industry. It's the proof of concept everyone has been waiting for. It proves the business model can actually work at scale. And you have to understand, that profitability wasn't some accounting fluke. It was driven by sheer, overwhelming scale. They shipped over 1.6 million Lidar units in 2025 alone. That is a 222.9% increase from the year before. Let that sink in. They more than tripled their output in 12 months. This is the kind of industrial scale production that doesn't just compete, it crushes competitors. This is the engine that's driving their incredible financial success. This is crucial. They are not just growing because the market is growing. They are actively leading the market. Hesai now commands over 40% of the entire long-range automotive Lidar space. This isn't some fragmented free-for-all where 10 companies have 10% each. No, they have carved out a dominant, undisputed #1 position. When you combine that kind of explosive growth with clear market leadership, that is the classic recipe for a durable, long-term competitive advantage, what some might call a moat. And hey, you don't have to take my word for it. The company's own leadership, the people in the trenches, they understand the gravity of this moment. The CEO, David Lee, he called it a landmark year. This isn't just corporate PR speak. This quote underscores the fact that this wasn't just another good quarter for them. It was a fundamental strategic inflection point. It was the moment that proved their model, validated years of grueling, heavy investment in R&D and manufacturing, and sent a clear signal to the rest of the industry. And to cap off this incredibly strong bull case, we have to look at the balance sheet. This is the financial bedrock of the entire operation. They are sitting on a war chest of over $1 billion in cash. That's a lot of firepower. But honestly, the most important line item here, the one that really gets my attention, is the last one. 3 consecutive years of positive operating cash flow.
This means the money coming in from their core business, from actually making and selling LiDARs, is more than the money going out to run the business day to day. That's the lifeblood. It proves the core business is self-sustaining. They're generating cash, not burning it. It means they have the resources to fund their own aggressive expansion without having to go, cap in hand, to the capital markets. That right there is a position of immense, undeniable strength.
All right, I have to admit, that is an incredibly strong foundation. You can't argue with those numbers. Profitability, commanding market share, a fortress of a balance sheet. On paper, it sounds absolutely untouchable. But the market is telling us a completely different story. The stock didn't rally on this historic news. It's sold off. So the big question becomes, what are we missing? What does the market see that we don't? It's time to stop admiring the steal and start searching for the cracks. Let's dig into the fear. Exactly. It's the classic paradox that you see in the market all the time. You see this beautiful, impressive building, but you feel a tremor under your feet. What's causing it? Because you have to remember, Wall Street is a forward-looking machine. It doesn't just price in what happened yesterday. It tries to price in what's going to happen tomorrow, next quarter, and next year. And something in Hesai's forward-looking statements gave those professional investors a reason to hit pause, a reason to sell, despite the incredible historic results they just posted. And here it is. This table right here shows the hairline fracture that caused the entire tremor. It all comes down to the guidance for the first quarter of 2026. Now, for anyone new to this, guidance is simply the company's own forecast for what it expects to earn in the upcoming quarter. Analyst consensus is what the pros on Wall Street thought they were going to earn. When those two numbers don't line up, you get fireworks and usually you get sell-offs. As you can see, Hesai guided for revenue between $93 and $100 million. But the market was expecting over $108 million. At the midpoint of their guidance, that is a shocking 11% miss. And let me tell you, in the high-growth tech world, a double-digit guidance miss is a cardinal sin. It immediately flashes warning signs and raises serious questions. Is their incredible growth finally slowing down? Are they losing pricing power to competitors? This is exactly what spooked the trading algorithms and the big fund managers. And that weak guidance wasn't the only stress point that analysts found. If you dig deeper into the numbers, as you can see on the left, there are other small issues that start to pop up. The full-year gross margin, that's the profit they make on each individual unit they sell before all the overhead costs, it actually dipped slightly. Now, it's not a disaster, but in a growth story, you want to see that number climbing, not falling. What was more concerning was the near-total collapse in their high-margin service revenues, which fell by almost 60%. These are often very profitable contracts, so a drop of that magnitude really hurts the bottom line. Now, to be fair, as you can see on the right, there is a counterpoint. Their gross margin in the fourth quarter itself actually improved year over year. This does suggest they're getting better at managing costs on a quarterly basis. But the market isn't looking at one single positive data point in isolation. It's looking at the whole picture. And these negatives, combined with that bombshell guidance miss, were more than enough to create a powerful narrative of fear. Okay, so the fear is understandable. Let's be real. A guidance miss is a tangible problem, and the market is right to be cautious. But this is exactly where we, as investors, need to separate short-term market sentiment from long-term strategic execution. The market is having a knee-jerk reaction to a single data point for a single quarter. Hesai, on the other hand, is busy building a global fortress that's designed to dominate for the next decade. They are playing a completely different game than the day traders. So let's contrast these two ideas. While the market is panicking about the Q1 guidance, what is Hesai actually doing? They're in the process of more than doubling their annual production capacity. They're scaling from 2 million units a year to over 4 million in 2026. You simply do not make that kind of massive, expensive capital investment unless you have extreme confidence in future demand. This single action, in my opinion, speaks much louder than any quarterly forecast ever could. They're not just hoping for orders, they are preparing for an absolute explosion in orders that Wall Street's models clearly aren't factoring in yet. And I want to be clear, this isn't just some idea on a piece of paper. This is a multi-year global strategy that is already in motion. You can see the steps. They hit 2 million in capacity in 2025. They're jumping to over 4 million in 2026. And by 2027, their brand new factory in Thailand comes online, specifically to serve skyrocketing global demand. They are doing the hard, expensive work of building a resilient, geographically diverse manufacturing footprint. This is the heavy lifting required to become the undisputed, unassailable global leader. And that future demand we talked about, it isn't just wishful thinking. It's being locked in with strategic partnerships right now. Becoming the primary LiDAR partner for NVIDIA's Drive platform, that is a monumental win. It essentially makes Hesai the default go-to solution for any automaker building on NVIDIA's widely adopted platform. They've also locked up an exclusive deal with Grab for the massive Southeast Asian market. And, critically, they've secured design wins with all 10 of the top 10 Chinese OEMs. Plus, you have this emerging trend where companies like Li Auto and Xiaomi aren't just using one LiDAR per vehicle anymore. They're using 3, 4, even up to 6 LiDARs per car. That trend alone massively expands Hesai's addressable market overnight. And this really illustrates that the story here is so much bigger than just cars. The CEO has a term for it. He calls it physical AI, and it's brilliant. It's about being the essential eyes for any machine that needs to perceive and navigate the real world. And they are already the #1 supplier for robotaxis. They're #1 for the emerging humanoid robot market. They're #1 for autonomous delivery robovans, and even for things like robotic lawnmowers. This level of diversification creates multiple, independent avenues for growth, and it insulates them from the cyclical nature of any single industry. Even automotive. They're not just building a car part, they are building a foundational technology for the entire next wave of global automation. So that brings us to the final showdown, the moment of truth. On one side, you have a company that is firing on all cylinders, hitting historic milestones and methodically building a global empire. On the other side, you have a nervous, skittish market, fixated on a few negative data points and 1-week quarterly forecast. It's time to weigh all the evidence, put it on the scales, and deliver the iron financial verdict. Let's see if the steel foundation holds up under this stress test. Okay, let's lay it all out, side by side. In the forge column, the bull case, the foundation looks incredibly strong. You have industry-first GAAP profitability, which is a monumental achievement that cannot be overstated. You have explosive revenue and shipment growth, which is undeniable proof of immense demand. You have dominant market share, establishing them as the clear leader of the pack. And you have a massive forward-looking capacity expansion already underway. But then you have to look at the fracture column, the bear case. That weak Q1 guidance is the main culprit, the big red flag. You also can't just ignore the slight dip in the annual gross margin or that sharp, painful decline in high-margin service revenue. And all of this culminates in the most powerful force in the short term, pure, unadulterated investor fear, which is what's driving the stock price down right now. So when you boil it all down, the crucial question is this. Is the market punishing a short-term hairline crack while completely ignoring the steel-reinforced foundation underneath? From where we stand, the long-term strategic actions, the capacity expansion, the NVIDIA partnership, the diversification are far more significant than one quarter's forecast. This looks like a classic case of short-term myopia punishing a long-term winner. For investors who have a durable temperament and a long-time horizon, this disconnect between the stock price and the business fundamentals could represent a significant opportunity to acquire a market leader at a serious discount. But let's be crystal clear about the risk. That guidance miss isn't imaginary. It's real, and it created a sentiment overhang that will linger. The market is now in show-me mode, and it will demand proof. So if you're a risk-averse investor, someone who can't stomach near-term choppiness and volatility, this might not be your fight right now. The company has to go out there and execute flawlessly to prove that Q1 was just an anomaly, a temporary blip. The foundation looks solid as a rock, but now they have the hard work of delivering on their promises and repairing that crack in investor confidence.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.